We now have an opportunity to discuss an ongoing project that we began some time ago here at IG to look at a portfolio of stocks that was put together for us, which were based on AIM shares that were protected from inheritance tax. Portfolio manager from Fundamental Asset Management, Chris Boxall, joins us now with an update, because we've been, as I say, talking to you a couple of years now about a portfolio of growth stocks that you put together, as you do as part of your business in doing this for clients. But you've also added extra spice now in January, putting together a high yield part of this. Explain first of all about your process in putting these portfolios together.
Well, we run a lot of money for inheritance tax planning purposes, and as you suggest, if individual investors hold qualifying AIM shares for 2 years and greater, and at death they fall outside their estate, with emphasis here on the qualifying, so they have to be qualifying AIM companies. And we put together, as you see, first of all, we put together a portfolio with a more of a growth mandate, what we will call a more standard balanced AIM portfolio, and it was thought to be an interesting sort of exercise to compare that, given the huge growth in AIM over the last few years and the terrific performance of many of these shares, to compare it with a high yield offering, which would be somewhat lower growth but have the support of yield, and that already is proving to be quite interesting. I really know that the yield is offering us, has it given plenty of interest over the first quarter.
Okay, well let's compare them a little bit later on in the interview. I want to pick up first of all on the growth portfolio. And this has been with us now for a couple of years, hasn't it?
It has,
And for those that have been following this series will recognise that most of these have been in there since the beginning. Explain what's going on.
Well, over the first quarter, broadly, this portfolio as a whole was down approximately 1.1%. And within that, we've had some strong performances and also some weak ones. And we've had some interesting announcements as well. We've also decided to replace a stock that we used to hold that previous viewers would see as gone now. And we've replaced it with a new stock in Focusrite. I mean, dealing with that initially, we used to hold a company called Restore, AIM quoted. It's about 640 million market capitalisation, and it's in the business of document storage, and it also has a smaller office removals business. We think it's super overvalued for a business that is really not doing much, not growing much, and not, the key to us, not generating much free cash flow.
Okay, so Restore has gone and you've replaced it by Focusrite. Now, Focusrite, to those that don't know the business, would wonder what it is they do, but when you find out a bit more about it under the covers, in fact, it's quite an interesting part of business life.
Yeah, it's a lovely little business, and we've held it since not long after IPO, which was in a few years ago, about 4 years ago. It was founded in 1989, the current structure of Focusrite, when Phil Dudridge, current non-exec chairman, who is a big shareholder, owns about 38, nearly 40% of the shares in the business still, he bought out the assets of Focusrite, and he's the former Led Zepp sound man. So it comes with a bit of heritage in this space. And Focusrite makes music and audio hardware, and increasingly now software, that initially appealed to the professional studios, sound groups, and now more so to the hobbyist amateur musician. So it's spreading across multiple, a growing universe of potential users. And it really is a polar opposite to Restore. This is a business that is growing terrifically organically. It hasn't made an acquisition lately. Just announced interim results. Revenue is up 20-odd% plus. Operating margins of 16%. Return on equities 20% plus. It's cash in the bank. It's a really nice business that a lot of people can understand. A lot of products out there, and we like it a lot. It's not that it is reflected in the valuation, but when all's said and done, if you ignore all the exceptional costs that the Restores of this world put out, like-for-like valuation is not, in terms of earnings model, it isn't actually that different between the two of them, albeit one is really growing internally, using its own cash flow to grow. And we would encourage anybody to have a look at this business. Nice, clean set of results as well.
Okay, that's Focusrite. Let's bring up the list, because I think there's a couple of stocks I really want to pull out from here. One of them is Patisserie Holdings, and we've spoken about this before. This has been a stock you've held for a while, and it's run by someone that in the business is quite well known. 19% gain. Now that's pretty good.
Yeah,
year to date.
We're staggered, actually. I mean, we hold Patisserie Holdings across our portfolios, and we're very surprised that it was the top performer of the quarter. Given the pressures in the dining out sector. Costa Coffee, part of Whitbread, have just announced, decline in coffee shop numbers, and these patisserie holdings is touching that space, albeit with the addition of nice cakes and pastries. So we're very surprised that shareholders have dismissed that.
Of course, this is the area that we're told, as people, we shouldn't be eating so much of.
No,
at the moment, there's sugar tax and so forth.
Miss a nice cake, though, can you?
Well,
It's pretty obvious. Chocolate and cake, chocolate and cakes, go for it. Hotel Chocolat's been doing pretty well as well.
Hotel Chocolat is another good example. Let's bring back the numbers and take a look at one of the poorest performing, RWS Holdings.
Yeah, that's
down 15% at year to date.
Essentially, that return is all reflected in what was this week's announcement, a trading update, which suggested that, well, they've got foreign exchange pressures. A lot of their costs are in dollars. A lot of their billing out's in dollars. A lot of their billing out's in dollars, but they've got dollar costs, but they've also got a lot of euro and European-based currency of input costs. So there's big foreign exchange pressures on their business. And I sense as well, in the market was disappointed by the news of their latest acquisition, Moravia, which does localization services, translation services. It was not quite as positive as maybe some were hoping for. This is a very big acquisition they made, and it seems that certain legacy client issues were unexpected legacy client issues, and I suspect that's been responsible for the 15% fall. The executive chairman of RWS has a huge stake in the business. Maybe now it's 30-odd%. He's never ever sold a share. Yeah. This is in going about 15, 20 years.
And you've told us before, this is one of the things to watch out for, isn't it?
I hate it. They've got to... When you go to the city and ask for 20, 40, 100 million quid, and you're not prepared to put your hand in your pocket, or you're not a material shareholder, it's totally madness. Total madness.
That was the growth portfolio. You've then got this high yield one. As I said, we started this earlier this year. Remind us why we did this, and what is it about high yield that you don't get in growth?
Well, a lot of clients in AIM are reluctant to give up the yield they're enjoying from their blue chips to reinvest in many AIM shares that don't offer much of a dividend. And they often ask, can we up the yield? And we have been very wary of that. But the improving quality of AIM has meant that it's now a far more viable option than it used to be. So we thought, look, why not introduce a high yield option? We don't run this expressly from our firm. We stick to running balanced portfolios for stocks we really like. If some just so happen to have a decent dividend yield, we'll buy them, but not just for the yield.
So it's
got to be a
for
growth.
Comparative purposes.
For comparative, but it was really built around the fact that it wasn't possible to run a portfolio like this about 10 years ago, or less than 10 years ago in AIM, because you'd have been left with very small companies, and the dividend would have been highly questionable or unsustainable. And that's even happened here. And as expected, it's producing far more, so we say, violence than the growth portfolio. And it's been quite fun to watch it.
You said growth was down 1.1%. I think this is down 4.4%, this portfolio.
Yeah, that's
high yield. I mean, that says it all.
Well, we should clarify as well, that's since when we first introduced it on the 23rd,
January.
Yeah. But it's been, you can see there's been to be one huge winner and some other horrendous losers, one of which we've had to drop from this and replace because it's cut its dividend entirely.
Well, let's talk about that one and why you dropped it. This was Safestyle. Explain what it is and why you dropped it.
Safestyle Holdings is a manufacturer of replacement windows and doors, the home improvement sector, and also it does conservatories as well. And the suggested yields, and it had announced its dividend at the last results, was implying a yield of about 6-odd%. It has cash in the bank, cash flow being previously good, and last week it announced that unfortunately it wouldn't be paying its dividend because the environment had declined massively, and it must have been pretty awful. Bear in mind this business generated more than enough cash to cover its dividend last year, and it's got cash in the bank. Clearly things have got pretty bad. It's also referred to an aggressive competitor that have been reducing prices to gain business. So as a result, we've had to drop that one and replace it with something else.
The one that you brought on to replace Safestyle is Zytronic.
Yes.
And at the bottom of the screen there, you'll see it says 0 clearly because it has no movement yet, but yielding 5.2%. What is Zytronic?
Zytronic, it's been on the market for a while, and in many respects it's never quite delivered on all its terrific promise. It's involved with what's called projective capacitive technology, touch technology. In simple terms, it makes touch screens, just the screens, so relatively niche. Increasingly we're seeing touch screens on very large signage in casinos, in gaming tables, roulette machines. Those are the kind of applications that Zytronic makes screens for. And it's a business that delivers high margins, nice returns on equity. It ticks all the fundamental boxes that investors should like. But really it struggled to sort of drive on, make the most of its listing in a way. It could do with other associated product offerings to add on to its core touchscreen offering. And the share price has been dropping down. It's got cash on its balance sheet, and it does have a history over many years through some tough times of consistently growing its dividend. So we thought it was a good opportunity to buy. It's got net cash as well, so we hope it will continue to deliver that dividend. Maybe shareholders will see a decent capital return as well.
Let's stay on this chart and go to the top of the list on the left-hand side, K3 Capital Group.
Yeah, this has been a staggering performer. At one point, this business year to date, the shares are up nearly 100% in the quarter. It's come off a bit now, and I think the yield you can see the yield when we started this was double, and it's a business sales company. So the economy's good, lots of activity in the small company environment, lots of business, company sales, brokerage. This business does very, very nicely. It completed a few big deals, a trading update, nearly every trading update that it's issued has said that results are going to be well ahead of expectations, and hence the shares have absolutely flown. The issue with this is if things slow down a bit, you could see it come off quickly as well. But its model is so cash generative that it can afford to just throw out a big dividend. It doesn't need much capital to run. You can imagine you don't need any big investment, no big equipment. It's all about people, commissions on the deals. It has a certain retained revenue as well, so it earns recurring fees from certain clients. But hence it gives out a terrific dividend. We were, the return to date was just amazing. Yeah. You can see it's really propped up our high yield offering in the first quarter.
Yeah. Just a general point, if we can, on AIM as a space to invest in at the moment. Yeah. We know, and we've seen so far, the benchmark FTSE 100 down on the year to date, with pressures being brought to bear on the global stage. What is AIM looking like at the moment as an investment opportunity?
In the first quarter, AIM was down as well, although half of the main market, when we talk main market, FTSE 100. So it did suffer a bit, and it's driven by those big companies, and we saw some sell-offs. But we've had a recovery over the last few weeks, and I suspect it's broadly flat about now as we speak. And there's still a great opportunity, great growth opportunities, real growth. I think illustrated by our Focusrite. Perhaps Focusrite versus Restore, going back to that, is a perfect example. Restore being a more main markety offering, and Focusrite being the higher growth, newer kid on the block. And that really illustrates the difference between real AIM stocks that people should be looking at and really the main market offering. So we think AIM offers some great opportunities, results from many of our holdings, and I can list a few: AB Dynamics, Bioventix, Fulcrum, Flowtech, Fluid Power, H&T Group have been fabulous. Interims and finals lately have been really good, really encouraging.
Matched as well by those stocks like Restore that failed to.
Restore, the issue with Restore is you are sort of semi-fudging in the numbers. Well, maybe I'm being a bit unkind, but we've stuck our neck on the block on this. Many investors, the city loves it. Yeah. So.
You pay some money, takes your choice.
Absolutely.
Chris, thanks so much indeed for joining us. Chris Boxall, Portfolio Manager at Fundamental Asset Management, running through his growth and high yield portfolios he put together for IG. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.